When people think about investments, the first thing they think about is what kind of returns can I get? But really, what they should also be thinking about is what level of risk can I take? Risk means that there is a chance that you can lose some or even all of your investment amount. And there is a trade-off between risk and returns. Low level of risks are associated with low potential returns, and high level of risks are associated with high potential returns. There are essentially two types of risk: company-specific risk and market risk. Company-specific risk, as the name implies, are risks associated with the company and the industry that you are investing in. And this type of risk can be easily reduced through diversification. Market risk, on the other hand, are risks associated with investing in the markets. And the market risk includes things like economic risk, political risk, interest rate risk, and currency risk. And such risks are inherent in investments and are unavoidable. We deal with risk in three ways. Firstly, through diversification. Instead of concentrating your investments in only a few stocks, we advocate spreading them across many different companies. And by so doing, we reduce the company-specific risk greatly. One of the most effective ways of doing so is via a unit trust, where you can invest in thousands of companies using a relatively small amount of capital. Secondly, we use strategic asset allocation, which is essentially the spreading of your resources across different asset classes such as equities and bonds. In this way, the gains in one asset class can reduce the impact of losses in another asset class, thus reducing the overall risk of your portfolio. And finally, we do regular rebalancing. Asset values move differently, and thus your original allocation will have changed over time. Rebalancing allows us to sell what has gone up to buy what has gone down, and thus bringing your allocation to the original allocation and thus maintaining your portfolio at a risk that you are comfortable with. Do not focus only on returns, but instead ask yourself, what is it that you're trying to achieve? To what ends is your investment supposed to bring you to? Because we believe that investment should be a means to an end and not an end by itself. We advocate that you do your comprehensive financial planning to find out really what are your objectives that you're trying to achieve. And by so doing, you'll be able to understand and know what is your need to take risks, your ability to take risk, and your willingness to take risks. Seek help. Talk to a trusted and competent advisor whose interests are aligned with yours, who will be able to assist you to find an asset allocation that is suitable for you so that you can sleep peacefully at night, regardless of what direction the markets are heading.